Good afternoon, this Tuesday, May 13th. Well, interesting day, developments today. The grain trade with the vigilante sellers, I call them the vigilantes because they're just algorithm computers designed to just sell at random to try to look for weak spots and circumvent any buying that would probably hold those levels. They overrun them to drive it lower. So we've seen more of that this morning. We have the old crop corn dropping below the price of new crop corn for a while there, along with the wheat trade tumbling lower as it does every morning. But interesting about today, it's Chicago wheat. When corn took out overnight lows, the wheat market during the day session, even though it went lower, did not take out the night session lows and yet turned higher initially. And it also started when Kansas City wheat got near $5, which we showed in yesterday's video, and we'll show it again today, how prior resistance becomes new support, and they hit that, and a little bit of short covering developed today. Nothing spectacular, but it's nice to see the turn higher, especially when you make fun of the full moon traders. I mean, yesterday was a full moon, and well, the wheat trade bottomed last night, so to speak. So we'll see. You got to get some more than a couple of days here higher. We need to see a total trend change. A lot of times the V bottom is nice to see. And so I'm going to show you some pictures throughout the country, throughout the world, I should say, Northern Hemisphere, that someday the wheat trade is going to become concerned about them rather than being focused inward here domestically on the improved prospects of wheat down in Kansas with all those rains as of late. But never mind the conversation of all the diseases that are developing. And of course, that cannot be rectified until the combine proves that problems with disease, and even still, a lot of the times that wheat goes to feed wheat, which competes with corn. It isn't absolutely destroyed. And so for that matter, having good milling quality wheat eventually arrives on the futures contracts. But that's probably for the September and December contracts to worry about later on. So let's look at some things that we should be aware of in the Northern Hemisphere, and then see what all the charts are saying for us after yesterday's action. First, let's take a trip over to Europe. I want to note here in Germany and in France, they have been dry, the northern half of France, where they grow their wheat. They've been dry for weeks, and through Friday, May 23rd, they stay dry. Now, over in the Black Sea region, they're looking at, over the next 10 days, a potential ½ an inch of moisture falling here in the areas of Ukraine through their major wheat belt. Russia, southern Russia, does finally get a good drink here in the southern portions, but we're left with a ½ inch throughout most of southwest Russia here on their wheat production, and not to mention it's going to be cold in there. This is the anomaly from today through May 23rd. Here is France, here is Germany. Moisture basically non-existent on the anomalies here going forward over the next 10 days. Now, talking about cold temperatures, we had frost last week in areas of Ukraine. Now we get some more frost temperatures here developing in eastern Ukraine, and for that matter, Poland picking up some frost damage potential here developing in this area. And here's Ukraine. So something to watch again. Northern Hemisphere, not so bountiful once you're looking outside the U.S. And of course, then there's China. Large areas that have not received any moisture and don't have any moisture through May 23rd. Just to remind you where the wheat is growing, I just pretty much circled that area. That's where the wheat's growing. It's not a topic today. We don't know why it doesn't make the DTN headlines, but it's becoming understood. China is going to be a buyer of world wheat later on this fall. Now, heat, there you can see in the far western portions, heavy heat, but even towards the eastern areas, this is where the wheat is growing. Heat returns here, and this is through the 21st of May. So what happened today? Well, Kansas City wheat, maybe the completion of a wave today, dropped lower in the night session, right on top of $5. We showed you yesterday how in 2019 and all of 2020, $5 was the top side of that wheat range for a year and a half. And quite frankly, even before that, well, there's an old saying, old resistance becomes new support. And just maybe we might get a V bottom start out of there. And that's something I want to talk about wheat here. I've been trading as a registered representative in this industry for 35 years. Been trading my first contract in 1986. That's how old I am. And I have learned that when seasonals, like for wheat, the last time you get a chance for a rally is around May 15th, and then it's just sell, daddy, sell until July 15th. But I've also learned when prices drop into what should be a seasonal high window, you get a counter reversal, and you will reverse that seasonal, and you can go up throughout that downtrending seasonal time window. It's similar to the grains and your 4th of July. Everybody knows if grains rally into the 4th of July, you sell. But there's also the scenario that if corn drops and beans drop into the 4th of July, be very careful. you can get a recovery rally into August as optimum production does not hold together. Kind of similar to last year, we bought them in August on those grains and then turned up. But nonetheless, wheat, Minneapolis, breaking lower. We have a lot of rain chances here for the next several days in North Dakota. Been 90s for 4 days, and then we get cold here for a while. Even have snow and frost warnings for Sunday morning. So anyway, down to prior support. I'd anticipate spring wheat to finally find some legs in here and try to follow the hard wheat and soft wheat higher. Kansas and Chicago, we try to get a recovery rally in here again as this market continues to move sideways from support to resistance until something can break them out. And even then, still, they get sold. But I think times are changing for wheat as this massive short position by the funds has to sometime liquidate itself. It can roll forward and keep breaking over the deferred contracts back to lows, but eventually something comes along and catches them. And that could be China, could be France, could be Germany. Who knows? Even India. Talks that our trade deals with India could include India buying wheat from the United States because we produce non-GMO wheat. They'll buy that for a foodstuff. Whereas if they buy any corn from us, it's for ethanol production. So speaking of corn breaking again lower today, breaking this concept of a potential triple bottom. So we're back to our original theory where it is A, B, C wave correction of a wave 2, possibly taking us into that 420 range where the market could potentially find a low, and then summer weather troubles maybe develop. That's a maybe thing. December corn did not follow the spot contract lower, making a low last week at the 78% retracement of last December's low. And then even today held trendline support. We showed you this yesterday. Trendline support. That'll be interesting. We can get through this week holding 440 and rally the rest of the week. We could be set for some grinding, waiting on weather to shift and improvements, or maybe trade deal talks again. We could get Japan, Vietnam coming in here in the next week or two. And boy, if they start buying corn, upping their buys of corn alongside of Mexico recently, that can change the outlook of new crop corn and show that the USDA is likely correct in increasing exports into upcoming new crop supplies. Beans, we have highlighted this diverging support of getting above the 200 100-day moving averages, closing on its high today after a very volatile session as soybean oil exploded after a lower start earlier today. The Republican writers of a new bill going through the Senate are putting 45Z into it through 2031, and the only feedstuffs that are allowed would be anything produced in the United States, Canada, and Mexico. That means you're out of here, China, and dumping your used cooking oil in here and tallow. So this is very supportive for bean oil and very supportive for soybeans. Even the weekly continuation chart, I showed you this 2 weeks ago. And I said, once we break through this on the weekly charts, this is a significant deal. We broke up, pulled back for 2 weeks, held it on a closing basis, weekly close, and now here we are, new highs. This can be substantially a game changer for these beans as we can move up, as we can move up here into this upper $50 range, which allows us, even if they keep beating down on meal on the crush, we could see beans in that $11 range that we talked about where we can sell some new crop beans. We are sold out on old crop, but we can make new crop sales near $11. And here's your November bean chart. We showed you this last Friday. We said very important. And of course, I zoomed this in a little bit, but there was the same hit back there. And we had a tag here a week ago, and then we were banging on it last week, and we said above 1035, beans get friendly. And we can do a measurement at minimum. This here move, when they equal them out, is to 1088, 1092. So we're excited about that. Maybe get some short-dated puts on, protecting downside action with minimal cost. And then if we get further problems with the November beans, with weather problems in July, August, we leave that top side open and, hey, we'll take $12 beans. I'm not saying it's going to happen, but you got to be aware that that's what can happen, and your marketing plan needs to take care of these scenarios. And that's why we like those short-dated options versus buying those expensive November bean puts. All we need is protection through August when the beans are made, and that's where the September new crop short-dated put is beautiful. Expires towards the latter part of August, and by that time we've already seen August. And if it's beautiful weather, the market is collapsing below our strike price, we get to just go long November beans from our strike price or roll our put forward with another in-money put that is worth less than what we've paid for up front. More complicated than it sounds here as I talk to you. We'll put a video together when it's important to know about it in the future. On cattle, pushing higher and pausing here. Yesterday's gap higher, not led with any follow-through buying. As long as this gap stays open, it's a measuring gap or it's an exhaustion gap. We plug this gap, there's that risk that 3 is done, and we could be entering wave 4, taking us back to the top side of wave 1 before another leg moves higher later in the year. I will tell you, I did do a measurement that if this is a measuring gap, it means I could take this leg here, apply it to this leg, and use your standard 1382, 15, or 1618 to do a measurement. I can tell you a 15 takes us up into the 218.5 range. A 1618 takes us to the 211 range on this wave 3 potential. But plug that gap tomorrow and it evaporates. Then your measuring gap could have been an exhaustion gap and says we're done here for a while. Now, feeder cattle did the same thing, showed this yesterday. If we are in a wave 3 extension of a 1618, 311 would be the target of this move. Again, you plug this gap, then it became an exhaustion gap, not a measuring gap. So understand the difference between the two. We hold tomorrow and the next day and push higher, then we're discussing the prospects of heading to those numbers I had just said in the aforementioned charts. Crude oil, one quick look. This is our current view of it. We had a wave 3 bottom, an A, B, C recovery here that sets off a final wave 5. But I'll tell you what, we got to take a look at this here on a grander scheme, and we're going to do a zoom in here. This is back at the original top, way at the top side, and we had a 1, that's your parentheses, a 2, that's your parentheses, and we're looking for a major 3, a large black 3 with parentheses. It's possible that if we get some trade deals coming together here, an improving economy for China taking a breath of relief with the 90-day relaxation of tariffs to try to get something worked out, that this scenario could be that this 5 right here could have been already here, and that in fact we had a 3, 4, 5 and done, and then we erase all this stuff here, and this becomes the 3 in a big mode, and now we could get a larger 4 inside of parentheses that can carry us up to the $70 valuation. Before then, a continuing lower in a wave 5 and a drill baby drill and a lower prospect of crude oil continuing lower later into the year. But we could get a bounce here now, possibly a bounce into July near $70. And I think that's a scenario we have to look at, and that this current rally to $64 may just be a speed bump, back off, and try to rally again. On the crude oil chart, you might wonder why we change the numbers like this. Well, that's because we're kind of like Lewis and Clark. Elliott wave is not perfect. It kind of tells you from where you've come to where you might be going. Kind of like Lewis and Clark moving forward. The landscape they're in, continues to look like this, and we think it's building to something here with mountains in our way and so on and so forth. So we're finding our way through the wilderness, and that's why this oil chart could be shifting, and just maybe a major low did occur when we double bottomed near that $51 valuation. I'm Eugene Grainer with Heartland Investor Capital Management. Hope you find this information useful.